So imagine this, a legacy PC company that everyone thought was boring hardware suddenly rips almost 200% higher in 4 months. And then an investment bank turns around and says, yeah, we're downgrading it. That's Dell in 2026. Dell Technologies stock went vertical after its fiscal Q4 earnings in late February 2026, with shares up about 217% year to date and more than 260% over the past 12 months by June 27, 2026. Yet on June 25th, 2026, GF Securities came in, slapped a downgrade on the stock, and Dell dropped more than 9% in a single session, landing among the biggest losers in the S&P 500 that day. Here's the weird part, this downgrade hit right after Dell reported record Q1 fiscal 2027 revenue driven by absolutely massive demand for AI servers. So you've got fundamentals exploding higher, the stock mooning, and then Wall Street suddenly going. Careful, this might be too much of a good thing. That tension is exactly what we're going to unpack. This video expands on my recent article for Barchart, published on June 27th, 2026, and the link to read it fully is down in the description. If you're into stocks and markets, hit that like button and subscribe for more breakdowns like this. Let's walk through what the numbers actually say. The big turning point was Dell's fiscal Q4 earnings report in late February 2026, where the company blew past expectations and lit a fire under the shares. From there, Dell rode the AI wave. In its Q1 fiscal 2027 results, reported on May 28, 2026, Dell posted record revenue of $43.8 billion, up 88% year over year, driven largely by explosive demand for AI-optimized servers. This isn't about selling a few extra laptops, this is about becoming a core supplier for the AI infrastructure arms race. Non-GAAP EPS rose 214% to $4.86. Operating cash flow came in at $4.1 billion, and the company returned $2.1 billion to shareholders. Impressive. Now here's where it gets spicy. On June 25th, 2026, GF Securities downgraded Dell, pointing to valuation concerns after that near 200% run since the February earnings print. The downgrade knocked the stock down more than 9% in one day, a pretty sharp reminder that gravity still exists. The note acknowledged near-term tailwinds from GB300 and HGX orders, but argued expectations were already elevated and upside looked limited after the massive run. And they're not entirely wrong to worry. By late June, Dell was trading at a forward price to earnings multiple of about 24.3 times, slightly above the broader tech sector's roughly 23.7 times. So yes, it's a premium, but it's not some meme stock at 80 times sales. The real concern, and what GF Securities is effectively saying, is that after a nearly 200% move since February, there isn't as much room for mistakes. So in one corner, you've got record AI-driven growth and a stock that's been a rocket ship. In the other corner, you've got a valuation that finally made at least one analyst say, okay, maybe slow down. And that sets up the real question. Is this downgrade a sell signal or just a speed bump in a longer AI-driven story? As of late June 2026, all 25 analysts covering Dell rate it a consensus moderate buy. Average analyst target sits around $487.18 as of June 27, 2026. Given where Dell was trading around that time, that implies roughly a 22% upside over the next year. The street high target is even more aggressive at $700, which suggests potential upside of about 75.2% from late June levels. Someone out there is very confident in Dell's ability to keep riding the AI wave. Put differently, consensus still points to more upside, but you can feel the tone shifting from just buy it to buy it, but don't expect another instant double. and that shift is exactly why we need a balanced view. Bull case, the AI infrastructure build-out is still in its early stages. Dell is executing at a high level, capturing real revenue and share, and guiding to $60 billion in AI server sales this year. One downgrade doesn't override multi-year secular demand. The recent pullback could offer a better entry for investors who want exposure to the AI server cycle without chasing the highs. Bear case. On the bear side, after a roughly 217% year-to-date gain and more than 260% 12-month gain, the bar for good results is now sky high. One downgrade, like the June 25th, 2026 move from GF Securities, can knock the stock down almost 10% in a day, because investors are suddenly very sensitive to any hint that the story might slow. And if AI capex moderates or competitors like Supermicro grab more share, there's not a lot of room for disappointment at these valuations. My take? If you bought Dell before that February 2026 breakout, you're playing with house money. This is where you at least think about trimming into strength and letting the rest ride. If you're looking at the stock fresh today, after the late June pullback, I'd call it a selectively attractive AI infrastructure play. Still upside, but this is no longer a no-brainer cheap story. It's you better believe in the next 3 to 5 years of AI demand story. This is not financial advice. Always do your own research before buying any stock. Past performance does not guarantee future results. If this helped, smash the like button, subscribe and turn on notifications. Drop a comment. What do you think about Dell stock? Is the downgrade a buying opportunity or a sign to stay cautious? And tell me, which stock should I cover next? I'll see you in the next one.